up, everybody?
Hi, y'all.
It's Jonathan Bunk, and you know our guy Hugh.
What's up, y'all?
It's another episode of Hugh Knows, and we're excited to share a special guest with you today. Before we get to that, though, just want to do our disclaimer like always. We run a branch for network funding called Bunk and Baker Mortgage Group. The opinions we share are our own, not a reflection of our parent company, and we are not giving financial advice. But we have a lot of great insights for you today, don't we, Hugh?
Yeah, absolutely. So let's jump into the agenda. So the first part of it, we're going to have a special guest, Dr. Slawson, who I'm going to introduce in just 1 second. He's going to take us through kind of analyzing what it's like to invest in real estate as a landlord, so leasing out properties that you invest in, what you should think about, the sort of pitfalls that you might run into. And then we're going to have our second part of our episode, and we're going to jump into market analysis. We're going to look at what's going on in the Middle East that might be impacting markets, the Fed funds rates, and what the futures market's expecting. And then we'll look into the jobs, what the report from last week means, and then also we'll jump into the Houston real estate market. So, but first, we're going to have Dr. Carlos Slawson come in and talk to us a little bit about real estate investing. And Dr. Slawson is a professor of finance at the E.J. Uso College of Business, where I graduated from, and he was the chair of the finance department when I was in school, and he's a widely published professor in real estate finance. And his students love him, his grandkids love him. He told me he was on a camping trip this last week with his grandkids. So we are happy to have him here with us today. Dr. Slawson, welcome.
Thanks for joining us,
Hello.
Dr. Slawson.
Greetings from Baton Rouge, Louisiana.
Yeah, and that's my hometown. And of course, Jonathan went to LSU as well. We're both LSU alumni, and so we both have lived in Baton Rouge. So we're happy to have you on today.
Yeah, we love all our Texas schools, but today you're going to hear from 3 LSU Tigers. So.
That's right. Dr. Slawson, you prepared some slides for us today. We would love to hear your analysis and really, take us to school. So this first part is called Schooled Investing in Real Estate. So yeah, let's jump into it.
Greetings from Baton Rouge, Louisiana. I just taught this morning for the last 50 minutes or so I'm warmed up. Hopefully I'll keep it within the time limit. Whenever I teach the real estate class, I start out the beginning of the semester really trying to get students to think about more than maybe their current exposure to real estate. A lot of students are exposed to brokerage or how to be a broker, but there's just so much more. And I really appreciate what you folks are doing and helping individuals in order to buy homes and to, buy investment properties. But day one, in chapter one, we take a valuation approach. And looking at my first slide here, I said, what is the real estate investor's goal? Some investors have the attitude, we have the attitude we'd like to make a lot of money. And in the worst case, I want to risk losing anything, right? Can I do this with real estate? And of course, the answer is no. But I believe very strongly that, and I've dedicated my life to the study of real estate, that real estate, especially within the United States, that we have property rights such that allow us to invest with the hope of some really good long-term investment. And so my second slide here is risk. Imagine an investor with $100,000 who's considering stocks or rental property. When we put money in stocks, that's it. I mean, we're not touching it. It's the most we can lose is what we put in. With real estate, there is more risk. If you were to put money into real estate, well, you may lose that, but you also may have other costs that occur. But we know from finance that if you have higher risk, then you can have some higher expected returns.
Yeah, but basically, Dr. Slawson, you're just saying that there's alternatives that you could put your money in the stock market, you could put your money in the bond market, and there's going to be different risk reward payoffs in both of those scenarios, and the same is true for real estate.
Exactly, and understanding that real estate is usually one component of our portfolios. That in the average individual, if they've accumulated some wealth, they're going to have stocks and bonds and mutual, they're going to have various other assets, and real estate is one component of that. But it is a hands-on type of investment.
It's not so passive, right?
That's right. And very, very local, so that you can hear what's going on in the stock market, you can hear what's going on in the bond market, and But real estate, there's always opportunities locally, I believe. My next slide is leverage. A huge factor in real estate investing um, is this leverage, right? So if I have here, let's consider a $500,000 property. It's a very simplified example. We're not talking about all the other cash flows and expenses, but just looking at the asset itself. If you have zero leverage and you buy a $500,000 property with $500,000 in cash and it goes up 10%, well, you've made 10%. It goes from 500 to 550. But what if you lever this? If you have 90% leverage, where you were able to acquire this $500,000 property with $450,000 in a loan and $50,000 in cash, and it goes up 10%, well, you just doubled your money. You've got 100% return. These are huge. This is what makes one of the things that makes real estate so exciting. It's very difficult to go out and borrow a lot of money on your stock portfolio, although you may can get margin and such. But a 10% move up is 100% return. Now, someone can say, well, you have to have 500,000 or you have 50,000, but really you could take the 500,000 and you could buy 10 houses, right? So you could really lever this. That's a big important component, and especially with the 30-year mortgage, since the 1950s, we have we as individuals can graduate college and expect to maybe go out and buy a house now with our contract in hand because of leverage, right? The next slide here, there's a kitten. Try to have some sort of a cute
I gotta have the obligatory kitten
class,
slide.
but somebody, we've seen these signs occasionally. I first noticed this at a flea market years ago. All unattended children will be given a free kitten. Well, for my grandkids, they're like, this is fantastic. I'm given a free kitten. And sometimes you see these, they'll be given an espresso and candy and free kitten. But I want to focus on the free kitten part. My kids, the parents of my grandkids, they may say, let's think about this a moment. And why? Okay. Because of the maintenance, right? So we have a couple of cats. We have a barn cat. We have a house cat. We have a couple of dogs. And there's lots of love, but there's also lots of maintenance. Even if they go for long periods of time where, they're really taking care of themselves, this happens. And so a lot of times, when it comes to real estate investing, the stocks, there's not much maintenance, right? But for real estate, someone has to take care of that. Now, does that mean you don't invest in real estate? No. But you just need to be aware, just like you say we don't get pets. No, we do. There's reasons that we do that. We can get real estate and we can expect higher returns. But so I have on here, the younger we are, the less we understand the cost of time. Talking about my grandkids and getting a kitten, and younger people have endless time, it seems. Don't approach real estate investing, especially if you're getting into it for the first time, when you have endless time to do maintenance. You have endless time to take care of the plumbing or roofs or landscaping. These have to be factored in as part of the cost. So real estate maintenance is one of those things that we should say, let's stop and think about this before investing. Now, one thing you can do is you can get a property management firm, and then it almost turns into a stock. You're working with the property management firm. They will take a cut. They will take a fee. You can adjust your rent according to the market. You want to keep in touch with what are the market rents, but you can actually delegate a lot of this to a property management firm.
Yeah, I think the big thing to share with the audience is there's so much value in investing in real estate. And, the last 3 years, our country's seen an explosion of people buying homes at all-time low rates. And now we're a little removed from that. People are taking new jobs, moving. Maybe they're downsizing. Some people are even upgrading. And those homes that they refinanced or bought during 2020, they're keeping them. And so we have all these accidental landlords. And I don't think these accidental landlords have counted the cost of all this maintenance.
Yeah, because if you get into a house, you're in it for 3 years, you probably haven't had to replace the roof, or your AC might have not gone out, or your hot water heater might not have been needed to be replaced.
Or it's your house. You take better care of it. When a tenant lives in it, you think they're going to care for it the way you did when you lived in it?
Yeah, or pipes haven't burst. For instance, I know we had in 2021, Houston had a really bad freeze, and a lot of people realized, here's a new maintenance risk that I hadn't anticipated. So, really contemplating those on the front end is going to be crucial for those people that are in that situation that have low interest rates on their mortgage and they're thinking about retaining their properties to rent them out. It's like, well, we really need to think about the maintenance costs. And what Dr. Slawson is like, there's a big time component to real estate. Yes, it's a very valuable asset. Yes, you can leverage it, but you need to consider this time and maintenance component. And that's why he's suggesting this property management as a route.
I've owned a few rental properties in the past with my brother-in-law who wanted to get started in real estate. He largely would put in the time, and he got me to largely put in the money and sign on the dotted line. But we both, there's a lot of joy and there's a lot of fun in owning investment properties. But whenever it comes to competing with other investors for these properties, really taking into consideration the maintenance cost. And actually, if someone is a current owner and owner occupancy, and then they're thinking of becoming a landlord, one of the things that they do have an advantage to know the history, because a lot of times whenever we purchase a property for investment, they may point out a few things, but you really know how this house works, and there can be an advantage there.
That's a great point.
Let's see. I'm going to the slide that says the bottom line. Cash flows.
People love that word, cash flow.
Man, cash flow. And when I talk about this in class, most of the models in our textbooks, they're going to somehow summarize when you buy, while you hold, and then when you sell. And that's what investors are doing, I believe. They're looking at all the details for these three categories, and there's a lot of details. But there's models out there that we can borrow and look at, and I know that you have an example here coming up that you sent me with some of these details. As we think about the details, sometimes people don't consider the when I sell, but this is not. As I sometimes say, it's not like it's not like a marriage where we vowed to death do us part, right? So in other words, we can have a 5-year, 7-year, 10-year time horizon. That's what investors are looking at, even if you might plan to hold on to it longer. And there can be some advantages to that. If you're to the point where we might keep this until death, then there becomes a huge tax advantage in having your children inherit this, or whoever your heirs are. But the wise investors consider as many of these details as possible in all three of these categories before purchase. And we're thinking about the risk, we're thinking about our required rate of return. And in finance, we can present value these cash flows and think about whether it's worth it or not. Okay, so the next slide is an example in the Heights. And you've set up an example here. We have the FICO score, loan to value ratio. That gets into the leverage, of course, the debt to income. And I'm sure that you guys really, you probably spend a lot of time here with this debt to income percentage. I used to teach, we used to have a personal finance class here at LSU. And so I would get involved with really thinking about maintaining. If you can learn to maintain your own life, that's what employers want. Now you can go out and you can help maintain their business. Well, the same thing works with running a house, maintaining a house. And I'm talking about the entire investment, running that as an investment. That's why the lenders look at these ratios. In part is, how have you managed your own life? Will you continue to be able to manage and make the payment to us? So this house in the Heights, purchase price is around $320,000. Monthly lease currently $3,000. Homeowners insurance, flood insurance should be a consideration. It's not applicable in this case. The PMI and the mortgage insurance, the private mortgage insurance. If you can get your loan to value ratio down to 80%, almost always you can avoid the private mortgage insurance. Likewise, through time, if the house price increases or the mortgage value, the mortgage balance decreases, whatever combination, if you can get to 80% again, then you can apply to have your mortgage insurance reduced. And then your property taxes, we have those in order to be able to pay for all of the good things around here, like the schools and the parks and our police force and such, libraries. But what is the model? We can look at all the details. What are the cash flows? And so the next slide, there's a loan breakdown here. Given the purchase price, given a down payment of $32,295 and a loan amount of roughly $290,000. Let's see, the example that I have here, what interest rate are you showing on the slide?
So we're showing a 3.5% interest rate. And so that equates, given the PMI, the taxes, the homeowner insurance, and the principal interest, that equates to a payment of $23.56. So that's the total mortgage payment, including all those factors, at a 3.5% interest rate.
Yeah, this is an example of somebody bought a house and now they've departed it and now they're renting it out. And like we said, they're renting out for $3,000 a month, and they're like, "Wow, my payment's only $23.56, so I'm cash flowing. Was that $644?
Yeah.
I'm cash flowing $644." But in actuality, how much money are they making, right?
So, in your example, somebody would say, okay, you're using 3.5%. It's because that's what the current owner has, and they're thinking about being a landlord. And what can I do? This, if I'm, you have the big three in here, right? So you have the taxes and the insurance and the mortgage payment. All right, but what this model does not have is the maintenance. And so that extra, what is it, 400 or 500, 600, I guess, in there, is that going to be able to cover the maintenance? Now, if someone were to bring this, say my son brought this to me and said, "Hey, Dad, I'm looking in order to be able to, convert my current home into a rental property." What I very possibly would do in this situation is I would look at that funds needed at closing. What are your current funds needed at closing showing on your model?
$52,000.
The 52,000, and so I would say, look, if you wanted to turn this into an investment property, then what I would most likely do is I would add 25,000 of that or 15,000 of that, and I would put in 65, 70, 75,000 into a particular account, and then I would use that account for all expenses, right? Because what you don't want to do is you don't want to get your rent, pay everything else, take the cash and spend it somewhere else. There's going to be a lot of issues there whenever it comes time to do the taxes. You can hire an accountant, but they're going to need the same thing.
Yeah, why don't you break up, a big thing with maintenance is you have operating expenses, but then you also have CapEx, right? You have capital expenses, right? The roof's aged, those types of things. Break those two down, kind of OpEx and CapEx.
Okay. So in a personal finance class, I talk about these three things in our personal lives. I talk about our vehicles, our health, and our homes. And so for each of these three things, there's the normal expenses week to week. And so for your car, for example, you've got to pay your insurances, and you've got to get your oil change, you've got your gas, right? But something's going to come along with your vehicle, and you're going to need to get a new battery. And I have to do that every 2 or 3 years here in Louisiana, right? And so, or I'm going to mess up my alternator if I don't. And so we have to have a new battery. You're going to have new tires. There may need to be some transmission work. These are capital expenditures that through time, it's not a matter of if, it's a matter of when. And we need to set those aside for our vehicle. Same thing with our health. So there's normal maintenance, but something's going to come up. God forbid, it'll be later than sooner. Okay. The home, you've got your mortgage payment, you've got your taxes, you've got your insurance. You do have your routine maintenance. You've got your light bulbs, your various things you may want to repaint here and there. But It's going to need a new roof. It's going to need a new AC system. It's going to need whatever your plumbing system is. There may be some issues there, not to mention appliances. And so if you're a landlord, whatever appliances you're supplying, but if you're a landlord, you're going to have to start setting aside for these, and you don't know when they're going to hit. And that's why I say, if you're going to buy a rental property and it shows you're going to need 50,000 at closing, I'd open up an account that has 60 or 70 or 75 in it, put that in there, pay the closing cost, and then as things come up, put my rent in there, pay my expenses out of there, and you're going to see through time, as you're a long-term landlord, that these capital expenditures for the roof and the new AC system, those are big. And maybe if you have a tree over your home, you're going to have to spend a few $1,000s to have a tree removed in your yard, or maybe it's growing on the edge of the property near a neighbor's house. All kinds of costs associated with that are true costs, but the investors are taking this into consideration from the very beginning. Just like getting the kitten, yes, it's going to be great and it's going to be food and things of this nature, but whoever has the kitten knows that long term I'm going to have to be taking them to the vet, and I've got to maintain this cat.
Exactly. And that's why I bring up that point. A lot of people, don't account for these things like, oh, I'm cash flowing $600 a month. And then boom, a new roof hits, or a weather event happens, or AC goes out. That's an $8,000 expense. There goes all your cash flow for that year. So it's like on paper, I'm going to cash flow. But then when you do your tax returns at the end of the year, you're like, wow, I had a lot of maintenance, a lot of expenses.
Yeah, I mean, I'll just give a personal example. My rental property that I have right now, its roof is 20 years old. And so our neighbor, who we're good friends with, came to us last week. It's like, we really need to replace the roof. And of course, I have positive cash flow on the property, but there goes basically all of my cash flow for the year that I'll have to be paying towards replacing the roof, which doesn't happen every year, obviously. But if you're buying a property, depending where you are in that roof's life cycle, you might have to end up replacing it if you hold on to that property. So,
in the long term, if we have our rent correct and we're taking things in consideration, it will work out. But real estate is a longer term investment. In the short term, there can be lots of stress and lots of difficulty.
Exactly. And like you said, the professional investor takes
Contemplates
all
that.
this cost into account when they buy a house. But the folks who, oh, we got a low rate, let me just rent my house and not sell it, they are likely not counting these costs.
That's right.
And the thing that I've learned the most that I share with clients is there's a hidden cost that a lot of people don't talk about. It's vacancy rate, right? What happens when your tenant decides not to renew that lease and they move out? Guess what you have to do, right, Dr. Lawson? You have to go in and do a make ready. You might have to steam clean the carpets, repaint, get the house ready, list it, get a realtor to help you. Now you got to pay commission to that realtor to get a new tenant in. Maybe it takes 3 months, maybe it takes 4 months to find a tenant. Now you have all these vacancy costs that can happen.
Those need to be taken in consideration. In addition, you could have it not vacant and they don't pay. And so now,
That's true. Yeah, legal costs.
if you rent for any length of time, any number of houses, it's going to run across where you have a renter there that is taking up the space and not paying, and you've got to figure out your rules in the local area for how to go about properly evicting them. I've had tenants in the past, and many years, many properties, and there was a time where someone said, "I'm not leaving and I'm not paying." And I said, "Well, I prayed with you before you moved in here, and you said this was a great place for you, but I've got to give you this notice, and I've got to go down and file the paperwork." These are all things these are part of the risk, right? And it doesn't mean that real estate is not a good investment. It just means you need to be aware of what you're getting into. My summary slide, real estate investment has risk. Leverage allows for some very high potential returns. Watch out for underestimating maintenance. And for accounting, tracking, investment purposes, don't mix rental funds and personal funds. And you may want to think about hiring a management firm. That way this is not going to, you're not going to get that call at a particular time. this is what investors are doing.
I'm a big fan of that. Yeah.
Yeah.
You sleep a lot better at night when you know if a toilet gets clogged or an AC goes out that your tenant's calling somebody who can help them a lot better than I could.
That's right. Yeah.
And I would warn family members and that haven't known. I mean, I knew because I saw the models, but I've had family members who've owned rental houses for a long time. One family member in St. Louis, and they owned it for like 30 years. And in their mind, they were like, "Oh, when I sell it, this is going to be the money I can make and keep." But they had forgot about the taxes, the capital gains taxes at the very end, especially if you've been depreciating it all along. Then there was a huge capital gain at the very end. And so when you get closer to the end of that investment, you may want to think about, okay, do I want to sell it or do I want to will it? Do I want my kids to get it or my heirs to get it? Because it can make a big difference in the cash flow there.
Yeah, no, that's excellent advice. Excellent advice.
Yeah, there's a lot of different exit strategies to real estate. I mean, from the mortgage side, I know some folks who've owned properties free and clear, and then they do a cash out refinance, and have the tenant pay the house down all over again and use that cash out money to invest in other investments or pay for their kids' college or buy another rental property. So that's the beauty of owning real estate.
Yeah. Well, Dr. Slawson, it has been excellent having you here. Thank you so much for your insight, for your wisdom from all of your years of experience and your knowledge in real estate finance. So we really appreciate it. So thanks for joining us.
Anybody who wants to follow up with me, welcome to. I'm Carlos Slawson here at LSU, and I appreciate being able to speak to a couple Tigers. And so I see Slawson at lsu.edu. Welcome to reach out to me.
Awesome.
Awesome. Thanks, Dr. Slawson.
Y'all have a great day.
Awesome. Now we're going to jump into the second part of our episode, jumping into our market update. So the first thing that we want to look at is what's going on in the Middle East. So unfortunately, actual war has broken out. And so we're having a couple of different headlines on the screen right now. Basically, this could impact markets in a couple of different ways. So it does actually have an impact on mortgage rates. And obviously, our heart goes out to all the people that are impacted by this. But one is oil prices. Oil prices have already gone up about 4% today. And the reason for that is that it appears that Iran has had some influence in the situation. And so analysts are worried that Iranian crude, which has been really restricted over for a long period of time, is going to get more restrictive. So that's going to remove crude supply from the market and push prices up. Now, that's not what you want to see. We don't want to see rising energy prices because that's going to hurt our fight against inflation. And so that's one of the risks that plays out. Obviously, this also just increases geopolitical tensions that could increase people's view of riskiness in general. So that might have an upward impact on bond yields as well. So
yeah, I mean, and Hugh and I are shooting this on Monday, October 9th. Like, there's a sad, tragic war going on right now, and no telling what's going to unfold the next couple of days. So you might be watching this video a week after we shot this, and things can really change. But when things destabilize, a lot of investors might seek safer investments, which is normally bonds. But because inflation is still high and the Fed has been so aggressive, a lot of people don't know if it'll respond that way.
Right.
So we're kind of 50-50 on how does this help mortgage rate, how does this hurt mortgage rates, but at the end of the day, what's happening is
it's increased uncertainty in the market. So something to keep our eyes out, our eyes fixed on, at least in the near term. Hopefully the situation, calms down quickly, but it's something that we're keeping our eye on. So, but as far as its near-term implication, what we've seen already is that the market has already sort of gotten more bullish on the Fed not increasing rates for the rest of the year. So the Fed fund futures, what the CME puts out, what are the odds right now? So basically, here on display, I'm showing the Fed funds futures right now, today, this morning, versus what it was on Friday, October the 6th. And so basically, after the Israeli war has broken out, the market is now saying that the Fed is more likely to not raise rates for the rest of the year. So that's obviously a good thing for mortgage interest rates, and so we're excited that that's happening. Obviously, for negative reason. But there's also other things at play. But is there anything you want to add about this before we move on, Jonathan?
No, I mean, the big question is the Fed going to do one more rate hike? And as new things happen, jobs data comes out, CPI data comes out, a war in Israel is breaking out, all this stuff is an input into the Fed's decision. And the market is trying to guess what the Fed's doing, and that's why we have this market survey. And so it looks like the market is, like you said, starting to think that we might not see
there are a lot
more.
of risks. And the government shutdown. So there's a lot of risks out there on the horizon. And if the Fed continues to act aggressively, do they risk upsetting the apple cart and not being able to achieve their soft landing? So the market's saying that the Fed is now more likely than not to keep rates steady for the rest of the year.
Do another pause.
And then we'll see rates starting to decline next year.
Yeah, the Fed doesn't meet in October, but they meet in
November 1st, and then they meet in December, and then they'll meet at the end of January. But right now the market's saying no more interest rates hikes from the Fed this year, so that's good news.
Yeah.
Last week we had a jobs report come out, so jobs, and it was a surprise to the upside. So there was more jobs added than what most economists expected. So you can see I'm highlighting that reading, the latest reading on the far right on this chart, and so this is showing the total new jobs added per month, and you can see that as I'm notating on the chart that actual number came in at 336,000 jobs added versus the 70,000 jobs that most economists forecasted would be added. So it was a huge miss by the expectations, and it's could be signaling that the job market is a little bit more resilient than not. Of course, what are the content of those jobs, and what sort of jobs are being added? That's a question that you and I have had over the past couple of days. Like, are these full-time jobs being added? Are these part-time jobs that are being added? What's the source of this of these numbers?
Yeah, and some of the things Hugh and I were looking at last week was the ADP numbers came out, and ADP is a big payroll company. It looks at the private sector a lot. Like Network Funding uses a certain payroll company. They have data. Network Funding is a privately held company. So ADP is a big vendor for all these private companies, and their jobs number was well below expectations.
Right.
And then the non-farm payroll numbers, which are the ones that the Bureau of Labor and Statistics, the government, comes out and says it's 336. And so, not knocking on our government, but our government doesn't do a whole lot of things well. And I don't know if they collect data well, because we've knocked the rent's equivalent. Well, the rent's equivalent on stuff where they like every 12 months. So the government doesn't collect data really well. So I don't trust this 336. I think it's a lot lower, maybe in the 200s to 250 range. And then a big part of this, when we broke it down, is hospitality and leisure is number one, and then government's number two.
So hospitality and leisure are those part-time jobs being added?
Yeah, it's bus tables on Saturday nights at a restaurant once a week.
Is it signaling that the market is really that hot? Maybe it's not as hot as those numbers might suggest.
Yeah, and government jobs can be seasonal. We have elections coming up. Counties hire people during elections. Cities hire people during elections. So it's like even some of the government stuff could be temporary short-term jobs. A lot of the hospitality and stuff can be someone working part-time.
And, there was the good news that wage inflation, so like the cost of labor has slowed. So that also came out.
Yeah, what people are making per hour.
So there might be more jobs being added, but if people aren't being paid more per hour, that they're working, then it's not going to have an inflationary impact.
Yeah. So if you're, last week, early first week of October, you saw mortgage rates kind of take off and all this job data came out. So that's why we're talking about it today, is all this number moved the market, but I think it's a little bit of a farce. And we just talked about the Israel stuff. Maybe we'll see some softening.
Yeah, towards the end of the year. Okay, so let's jump into the Houston-specific market statistics. Let's see what's going on in the real estate market in Houston. So on display right now, I'm showing a couple of different slides. First one is I'm showing Harris County unit sales, so you can see in 2023 versus 2019. Pretty close to 2019 numbers, so it's looking more like a normal year after we had some gangbuster years in 21 and 22. And then the chart to the right, I'm showing housing units going back to 2018, and I'm breaking those down by the different price points. But you can see that the 2023 pattern, we have this seasonal pattern, units and prices increase kind of in Q2 and then fall off in the second part of the year. And so we're seeing that emerge already in 2023, but you can see it looks pretty similar to 2019, a little bit lower, but pretty similar, especially considering that rates are a lot higher than they were in 2019 currently. I think that's a pretty good sign for the Houston market. And of course, a lot of that's being driven by the low inventory. And so you can see the inventory numbers from yesterday. 3 months of inventory. We need 4 to 6 months of housing inventory to have a neutral market. So we're still well below that neutral market territory. And that is going to keep prices from falling too much. Obviously, there's a seasonal pattern. We've already seen prices come down a tiny bit over the past couple of months, but not very much. There's that seasonal pattern, but overall, low inventory indicates that we're going to see prices sustained, essentially, and especially going into next year. And it's just I think it's a relatively positive message that you see the units keeping pace. A little bit under, but almost pretty close with 2019 numbers this year, given the interest rate regime.
Yeah, and if I think back to 2019, inventory was probably a little higher than 3 months. It might have been 3.8, might have been around 4, which is normal, like you said. But when I see that we're at 3,698 units for 2023, I'm like, is that because inventory is so low? Is that because interest rates are a lot higher? Obviously it's probably some combination of the both of those. But what I really think about if I'm a realtor right now and I'm talking to buyers is kind of like what you just said. It's like prices are probably going to go up. And even the mix of that 3 months of inventory, I call it the market of the undesirables. Like the inventory that is on the market is homes that are at bad location, might need some work, that were hard to sell. Because the homes that are desirable, that great neighborhoods that are priced right, what are we still seeing, Hugh?
Yeah.
Multiple offers,
yes,
right?
Exactly.
I know Austin had one recently. It was like 10 offers.
Yeah.
And so it's like we have almost 7 or 8% interest rates, low inventory, and we got things going on with the Fed, and people are still putting 10 offers on a house.
No, yeah, I had a agent that had a listing in the Heights, and there were 4 offers on the property within 2 days of it being listed. So there's still definitely a lot of demand. I think that it really is an inventory situation to a large extent, and that is driven by interest rates, but not in the way that you think of it. It's not that the interest rates are so high people aren't willing to buy. It's that interest rates are so high people aren't willing to get out of their mortgage. And so, and of course, like we just talked about earlier in the episode, you need to consider if you're going to keep your house as a rental property, you really need to consider those maintenance costs. So, maybe something to consider as you're thinking about buying. If you have a property, maybe it might be a good idea to sell that property if you're not willing to sort of consider all of those different costs.
Yeah, exactly.
Yeah. Anyway, so that is it for this episode, and we appreciate you tuning in as always, and catch us next time.
Adios.
Peace.